Hi, and welcome back to Channel 11. I'm Ken Shinoda, your host today. Tuesday, July 2nd, review of the month of June. We're calling it Tech It to the Limit because tech has been ripping. We all wish we owned more mega cap tech. It's just been the land of gains for the tech market. And here's our land of gains chart, S&P 500. The rocket ship has been up and to the right with a happy face. Now, for the last couple of months, we had that brief dip there in April. Turned out to be a good buying opportunity. And here we are kind of near the highs on the S&P with some market prognosticators talking about how the breadth of the market's gotten pretty weak and maybe we'll see some choppiness and volatility going into the election. But as we look at June, the winners was tech, the NASDAQ, EM playing a little bit catch up, now up 8% on the year, though one of the worst performers with obviously the NASDAQ, S&P being the top performing parts of the US markets, up 19 and 15% respectively. The Nikkei up another 3, now up 19%. Year to date, global equity up 12. The Dow laggard, more of an industrial value type play. Also Russell 2000, small cap value play, doing one of the worst performing sectors out there, actually down on the month. Now up only 2% on the year. Europe up 10, down 1, probably has to do with some of the UK election worries out there, and the FTSE down 1 on the month, up 8. Now looking at the different sectors, it's growth and momentum yet again, continuing to march along. Information technology, just the winners keep winning, and that's kind of the theme that we're going to talk about today. We've looked at this chart a couple times. Mag 7 in the red up top, and you can see the S&P and S&P X Mag 7 in the blue, and then last but not least, the equal weight, which many value buyers have been saying a better way to play the market is by the equal weight because you don't get all that Mag 7, but really that Mag 7 was where you wanted to be. So equal weight up on the year, up 425, but one of the worst performing parts of the market on this page, given outside of those big tech stocks, many stocks are going sideways or just slightly up this year. Winners keep winning. We looked at this last month. S&P Infotech versus S&P Infotech equal weighted index. So again, you got to own the winners in this market to keep winning. And if you went that equal weighted route, while it does seem prudent from a risk management standpoint, it just has not been working, even if you owned that equal weighted tech. Now, looking at seasonality from that standpoint, July tends to be a pretty good month. You can see going back since 1950, past 20 years in blue, past 10 years in green, and election years, on average, an up month. Things start to get a little bit more choppy going into September. So let's see how this July turns out. S&P is up yet again as I speak here right now. NVIDIA versus Berkshire. This is some slides. We got some inspiration from Deutsche Bank. Shout out to Jim Reed and team out there. We love your work. But they were joking that it took 60 years for Berkshire Hathaway and Warren Buffett to grow that company to be worth $1 trillion. And in just 30 days, NVIDIA went from $2 to $3 trillion. Here's NVIDIA. You can see kind of flat line through going back 10 years. It's now worth more than Germany, France, and United Kingdom. All their entire stock markets, NVIDIA is worth more than all of those together. The $3 trillion club, these are now $3 trillion companies, NVIDIA, Apple, Microsoft. If you go back to 2010, the top 3 companies comprised $500 billion of market capitalization, and now together they comprise almost $10 trillion of market capitalization. A pretty remarkable stat right there. Here's a look at the Mag 7 relative to the rest of the world. Those 7 stocks outside of the US stock market are bigger than every other country's stock market put together. Now, of course, these are multinational corporations. They're obviously very high quality companies, but again, these are just very interesting stats out there. This shows you the market capitalization of the top decile of US stocks relative to the rest of the market. And you can see that this is the least amount of depth and breadth that the market has had going back to 2000 before the dot-com bust, and then going back to 1929 before the crash of 29. Now, a little different from the dot-com bust. These companies do have cash flows. They're making money. So this time some say is different, but nonetheless wanted to show these interesting stats to our viewers here. This is semiconductors versus the S&P. Chips are better than everything, and it's another remarkable stat. And the last time we saw anything like this was, again, 2000 dot-com bust. Now, I'm not saying it's going to be like that, but just noting that some of these relative relationships have gotten back to those points. Growth versus value, again, almost the same as when we saw in 2000, right before the dot-com bust, with really those small caps lagging. If we do see a reacceleration of growth, you would think that eventually the rest of the market and those small caps play catch up. But for now, it's staying with the winners, and with the winners keep winning has been the place to be. Here's our speculation tracker looking at things like crude oil and Bitcoin. Bitcoin has seen some weakness. We had noted that in April, some of these had turned over pretty hard, and then we had a big rebound. But I'll note that we're off the highs on some of these speculative things like cocoa beans, which had a huge run and are now basically looking like a little double bottom here on the top right. Commodities, kind of a mixed bag. Down as a basket. Crude oil up on the left, and you can see Bloomberg Commodity Index is down 2. The Goldman Index up 1. They own different things within those indices. Gold up flat on the month, up 13% now year to date. And so depending on what commodity index you use, you're up a little or you're up a lot, and it's kind of been a mixed bag. But broadly, kind of a flat line this year. If you look at the Bloomberg Commodity Index, you can see we've kind of gone sideways to up a little bit for commodities. U.S. dollar index has been pretty strong. It's moved with rates, and you can see here we're kind of at the top end of the trading range of the dollar. In April, it got up to about a little over 106. Here we are at almost 106, 105.8 right now. So if rates keep backing up, you would think that dollar is going to remain strong. So staying long dollar probably is the right trade in the near term. I wouldn't be shorting given the backup in U.S. rates here. Looking at 2s, 5s, 10s, 30s across the curve. 2s have kind of flatlined right around that 475 area. And what's been more volatile has been the long end. You can see that the 10-year off the lows of around 420, getting up to about 450-ish. We're at 440, I think 446 today. Also, the 30-year backing up. And I think this is less about growth, and it seems like more of this happened after the debates, and maybe more, concerns coming out about the fiscal situation and more debt issuance. Maybe it has something to do with that same theme in France and in Europe broadly. And it's something that we dealt with in October of last year when we started seeing an increased Treasury issuance, and it seemed like lots of fears and talks about budget deficits that all kind of went away with the rally. And here we're coming towards the election, and maybe some of those fears and thoughts of excess or too much fiscal spending, high deficits coming back into the marketplace. So watch out for that long end. I think it's going to be more policy sensitive, the fears about more fiscal on a go-forward basis. 2s, 10s, finally making some movement. We've kind of been trading in a trading range on 2s, 10s. It hasn't quite broken out of that trading range, but we were kind of in that negative 45-ish plus or minus 5 basis points forever, and this is the least inverted that we've seen in quite a while on 2s, 10s after the 2-year has been stable and the long end has been moving higher. And what's interesting to note, I think, is that one of the things that had been driving long end yields down was that economic data had been surprising to the downside. You can see the City Surprise Index moves very in tandem often with the 10-year Treasury yield. And we had a big collapse in economic data, surprising to the downside. Yields had moved in line with that, but more recently, they've been breaking out. This is what I was saying. Maybe this is less about economic data and more about concerns about fiscal stimulus and deficits in the future. Bloomberg Surprise Index, same thing. Negative surprises to the downside, again, corroborating that City Surprise Index. So what's happening now? Well, the market is pricing in about 2 cuts through December 24th. And the Fed came out and changed their dot plots last month, saying that they are projecting 1 cut. So I guess we'll have to wait and see who's right. I think everyone expects at least 1 cut starting in September of this year. So it's really going to be data dependent on how that data comes in if they cut more than once. So right now, the Fed's saying once, the market's saying 2 times. So looking at June, fixed income returns are positive in June as Treasuries rallied. High quality fixed income led the way as there's just not much spread tightening left in some parts of the markets, and so it's just a matter of a carry trade. So credit, slightly positive returns, really higher duration bonds benefiting from that rally that we saw. into the end of the month. Selling off here, though, to start July, and about up 1% plus or minus for most sectors. Now, year to date, much different story, with the index down about 70 basis points, high quality fixed income. Treasury is down about 1%, agency mortgages down a little bit over 1%. And then the place to be has been riskier credit. CMBS playing catch up 12 this year, lagging last year. Levered loan triple C is up 8.8. So being in credit and not in duration is the place to be. Corporate bonds, longer duration, down about 50 basis points. So you want to be in riskier credit or floating rate credit or short duration, securitized credit. Looking at spread changes, here we see that spreads largely, kind of a mixed bag actually. Spreads are down in CMBS, triple Bs, CLO triple Bs, flat for ABS, and then a little bit wider for CLOs and bank loans, emerging markets. So kind of a mixed bag, not much movement year to date. It's been those securitized sectors playing catch up. You can see CMBS, CLOs, ABS. Mortgages, while they've rallied recently, they're still wider on the year. Relative value, we've been looking at these charts a lot with our hypothesis that securitized would play catch up. You can see on the CLO side it has, and it's also doing so on the rest of the markets, albeit you can't see it so aggressively because corporates keep tightening too. But if we look at our relative value chart, these dots keep moving down, especially the credit dots. ABS made a big move down very recently, as did RMBS. CMBS, less so, but still in the 70th plus percentile. And then agency mortgages, lone wolf, the value trap for the last couple of years. But where corporate valuations are, we do think that agencies are attractive relative to historical valuations and will create some excess return going forward. In fact, last month was one of the best months of excess returns for mortgages versus treasuries in quite some time. So that's it for June. We'll keep it short and sweet. Hopefully you're in those winners that keep winning. But fixed income kind of moving sideways, down as a basket in the index. But if you owned short duration credit, you're doing okay. So hope everyone has a great summer, and we'll catch up next time. Good luck out there.